If you had invested $10,000 in VOO in 2010, you would have $37,500 by 2020. Hey everyone, it's Prashant here. Welcome to my YouTube channel and thank you for joining me in today's video. In today's video, we're going to be talking about one of the most exciting topics when it comes to personal finance, and that is the stock market. I'm sure you've heard stories of some people, or maybe even know somebody personally who's lost a lot of money in the stock market. And it's stories like these that make people scared of the stock market and makes them prefer to sit out, missing out on a huge wealth building opportunity. In today's video, we're going to be talking about what the stock market is, cover some basic investment types, and learn how to start investing in the stock market. Guys, before we go on, I want to take a second to ask you to hit that like button and the subscribe button. And please share this video with somebody you think would find this video beneficial, like a friend or a coworker or even a family member. This will help me a lot with the YouTube algorithm and keep me motivated to keep making these videos. That being said, let's get back to our video. Now, I hope you're as excited to learn about the stock market as I am to share with you what I know. The stock market is simply a place, physical or virtual, where investors meet to trade investments such as stocks and bonds. The stock market is made of several exchanges that are set up across the world in many different countries, such as the New York Stock Exchange in the US, the Toronto Stock Exchange in Canada, the London Stock Exchange in the UK, Euronext in the EU, the Bombay Stock Exchange in India, the Shanghai Stock Exchange in China, and the Japan Exchange Group in Japan. In essence, the stock market matches sellers and buyers so they can trade stocks and bonds at a price that they can agree upon. Historically, stock trading was done in person, with traders shouting at each other exactly what they wanted to buy or sell at the price they wanted to buy or sell at. You might have seen this in movies or in pictures. Nowadays, though, most of the trading occurs on computers and increasingly on your phone. Okay, now that we understand what the stock market is, let us learn about two basic investments: stocks and bonds. A stock or share gives you partial ownership of a company. For example, if a company issues 100,000 common shares and you buy 100 of those shares, you are now owner of 100 over 100,000 or 1 over 1,000th or 0.1% of that company. Stocks typically come with some privileges, including voting rights and a share of profits in the term of dividends as well as capital gains. Companies issue stock to raise money, which they can then use into research and development of products, acquiring assets such as new machinery or a new factory, and so on. The price of a stock is set by the stock market. In other words, investors analyze and reanalyze the intrinsic value of a company, including its tangible assets, such as lands, machinery, and factories, as well as the intangible assets, such as the brand name itself. Now, if a company is doing well and is making a lot of profit, such as Apple, or it is expected to make a lot of profit in the future, such as Tesla, usually the price of that stock will go up. If you happen to be holding stock in such a company, you're in luck, and the value of your stock holdings will typically go up. On the other hand, if the company is not doing so well, the value of your stock holdings in this company will typically go down. So you see, when you own stock, your fortunes are tied to the fortunes of the company, just like the owners of that company, which is exactly how it should be. After all, you are a partial owner of the company because you bought their stock. The stock market allows people to easily buy and sell stocks to each other. The good news is you don't have to personally go and find a buyer when you're trying to sell some stock. Or you don't have to find a seller when you're looking to buy some stock. You simply place an order into the market for the stock you want to buy or sell at the price you want to buy or sell it at. And the stock market simply finds a seller or buyer who's looking to buy or sell that same stock at the price that you'd previously asked for. Then the stock market simply matches you two and the trade goes through. If the market is unable to find another person who wants to buy or sell whatever you're selling or buying at the price you want, the trade does not go through. That's it. It's pretty simple. The market today is very efficient. There is virtually no time lag between placing an order, matching that buyer or seller with another seller or buyer, and the trade going through. It all happens in the blink of an eye. Okay, now let's turn our attention to another investment, bonds. A bond is basically a loan made by an investor such as yourself to a company or even a government. That's right, you can loan money to your government. You might have heard recently that the US federal debt has reached an all-time high, especially with all the stimulus spending we've been seeing recently. In fact, as of the date of me recording this video, the US national debt is over $27 trillion. That's 27 followed by 12 zeros. Crazy, right? Have you ever wondered who the US owes all this debt to? The debt is owed to investors who buy US government bonds, including people like you and me. When issuing a bond, the borrower is basically making a promise to the investor to make interest payments for the duration of the bond as well as returning the principal by the date of maturity. This is very similar to any other loan, such as a car loan. For example, when you take out a car loan, let's say $10,000, you're basically promising the bank to pay the principal of $10,000 back in addition to, let's say, $1,000 of interest over a 5-year period. Bonds work in pretty much the same way. Bonds are issued by companies to finance purchase of new equipment, hire more employees, or expand into a new market. Bonds are issued by governments, municipal, state, and federal, to fund stuff like infrastructure spending. It is very important to note that all investments carry risk. For example, if you own stock in a company and that company does really poorly, the value of that stock can crash, leading to a huge loss to you. If you hold bonds in a company and that company goes bankrupt, chances are you will not even be able to get your principal money back, let alone the interest payments. In general, bonds are widely considered to carry lower risk than stocks. Because of this, bonds typically provide lower returns than stocks do. The general rule of thumb, higher the risk, higher the reward, applies when it comes to investing. Let me show you how different returns might be when investing in stocks versus bonds. For this, I will be using real-world examples. In fact, I'll actually use stocks and bonds that I'm personally invested in. For the purpose of this comparison, I'll be using two index exchange traded funds, or ETFs. The stock ETF we'll be talking about is VOO, and the bond ETF that we'll be using is VGIT. We will be comparing the performance of these two funds over the last 10 years, from 2010 to 2020. Let's dive in. The stock ETF is VOO, Vanguard's S&P 500 Index Fund. Over the last 10 years, this fund has provided an average annualized return of 14.16%. This means that if you had invested $10,000 in VOO in 2010, you would have $37,500 by 2020. The bond ETF is VGIT, the Vanguard Intermediate Term Treasury ETF. Over the last 10 years, this ETF has provided average annualized returns of 3.05%. This means that if you had invested $10,000 in VGIT in 2010, you would have $13,500 at the end of 2020. Now you might ask, Prashant, isn't investing in stocks the clear choice? The returns are not even comparable. In fact, I can make 10 times as much money if I invested in stocks than if I invested in bonds. And this is true. Investing in stocks has the potential to provide you much higher returns than investing in bonds. But here's the thing to remember. Stocks carry a much higher risk than bonds. There's a decent probability that one stock or even a stock index fund may lose value over time. What if there's an economic slowdown in the form of recession just before you were planning to take that money out? You could lose out on most or even all of your potential gains and even the principal that you had originally invested in stocks. Now, bonds have risk too. Companies routinely go bankrupt and are unable to pay back their debts. However, this risk can be mitigated by investing only in investment-grade bonds issued by long-standing, trustworthy companies who have a good track record of paying back their debts. Or you could lower this risk even further by only buying US government bonds. The US government has never defaulted on its debts, and its bonds are widely regarded as the most stable bonds there are out there. The point I'm trying to make is, both stocks and bonds have their place in the portfolio of a smart investor who's investing for the long term. It is up to each individual investor to figure out how much returns they're looking for and what degree of risk they're willing to accept in order to go for those potential gains. For example, if you're very bullish and you believe you will not need the money that you're investing right now for a very long time, you might go all into stocks and hope for a very high return. However, if you are bullish and you want high returns, but you still want to protect your investment in the event of an economic downturn, you might decide to go 90 or 80% into stocks and the remainder 10 to 20% in bonds. Or perhaps you think you're going to need the money relatively soon, or you're close to retirement, so you put maybe 60% into bonds and only 40% into stocks. So you see, the decision of how to divide your investments into stocks or bonds is deeply personal and is based on your individual situation, including your income, your ability to save and invest, your age, your goals, and your risk tolerance. There are people out there who've made it their entire careers giving advice to people on how to invest their money. But at the end of the day, it is the responsibility of each investor to understand what the risks are in investing, what the potential rewards might be, and make a decision based on that is best for their unique situation. I hope that everybody watching this video so far understands what the stock market is, what stocks and bonds are, and what the role of every investor is. Now let's start talking about exactly how to start investing in the stock market. I got interested in the stock market when I was about 16 and living in India. At the time, I did not know how to invest in the stock market. To be honest, I did not even know what the stock market exactly was. All I knew was the news was always filled with news about the stock market. And there were constant headlines in the newspapers about the stock market hitting one record high after another. After I moved to the US, got my master's degree, and got my first job, that was when I finally took a serious interest in the stock market. In fact, the real incentive that I had was when I realized that the retirement plan offered by my employer, a 401k, invested in the stock market. That's right, if you're a participant in a 401k or a 403 retirement plan, whether you know it or not, you are invested in the stock market. Now I'm 28 years old and I have made it my mission to understand the stock market inside and out. And even though I believe that I'm a lifelong learner and learning never stops, I do believe that I have a solid basic understanding of the stock market. I know enough about it now to make sure I utilize the stock market to invest to my advantage with a goal to increasing my returns while keeping my risk at an acceptable level. Let me tell you a story. My first foray into investing outside of my 401k was when I opened a brokerage account with Robinhood. I remember I bought 22 shares of Snap, the parent company of Snapchat, at $25.32 each in March of 2017, shortly after their IPO. At the time, I thought this was an easy way for me to make some money since Snapchat was an app that I and all of my friends enjoyed using. And I thought there was nowhere for the stock to go but up. Unluckily for me, the price of the stock started plummeting immediately after I bought it and even went down to $5 in December of 2018. After that, the stock started a steady climb upward, and I finally sold it in September of 2020 for $26.21 per share. So I ended up holding the stock for 3 years, and I made a profit of just $19.58, or just 0.03%. This is an absolutely horrible return. Of course, as luck would have it, the price of this share has been climbing steadily since. And as of January 23rd, 2021, when I'm recording this video, the price of Snap shares is $53.60. Had I held on to my stock, my profit today would have been $497.76, or just over 111%. Go figure. Now, this experience gave me two very important lessons. Number one, picking a winning stock is nearly impossible. Even though a company's product might be very popular and might appear to be a clear winner, gains in its stock price are not guaranteed. Number two, market timing is impossible. There is no way of telling which way a stock is going to go. It is just as likely to go up as it is to go down. And there is no way to predict with certainty what's going to happen next. Sure, industry experts can give their opinion on what's going to happen with a particular stock, but that's all it is, their opinion. Keeping this in mind, and during the time frame that the Snapchat stock had lost most of its value, I embarked on a journey to understand how to invest responsibly rather than just gamble. I read books on investing by highly respected investors such as Warren Buffett and David Swensen, and I watched hundreds of YouTube videos to learn exactly how the stock market works. I even talked to my friends, family, and coworkers to get their thoughts on the topic. After doing all of this research, I have settled into using index funds to do the bulk of my investing. I'm going to be making another video all about index funds, what they are, how to invest in them, how much it costs to invest in them, and how much returns you can expect from them. Keep an eye out on this channel for that video. For this video, I want to talk about how to get access to the US stock market. This is pretty simple. As long as you are a US tax resident, you can open a brokerage account. This is an account you open with a brokerage firm and use the money that you put in this account to trade many different types of investments, such as stocks, bonds, index funds, ETFs, and many others. There are many brokerages out there, including legacy brokerages like Charles Schwab, Fidelity, Wells Fargo, as well as newer brokerages that are focusing a lot more on the newer investor, such as Robinhood, Acorns, or Webull. There are even non-profit brokerages such as TIAA and Vanguard. I'll be making another video comparing different brokerage accounts and talking about the different features each of these offer. Stay tuned for that video on this channel as well. Once you have a brokerage account set up and deposit some money into this, now you get to do all the research on the stocks and bonds you want to buy. Buy those investments and hopefully see the value of those investments go up over time. Investing in the stock market is one of the easiest ways to get your money to work for you, and it is very important to learn if you live in the US, UK, or a similar economy so that you can live out in comfort in retirement. Lucky for us, in today's day and age, there are a ton of widely available free resources to learn about the stock market, including this YouTube channel. If you want to start investing and would like to use Robinhood or Webull as your brokerage, I have put links in the description below that you can use to sign up for these brokerages. If you use the link below for Robinhood, you will get one free stock valued up to $200 when you sign up. And if you use Webull, you can get up to 4 stocks, each valued up to $1,600 when you sign up and deposit $100 on the platform. That's all I have for you guys in today's video. Please, if you enjoyed the content in this video, go ahead and hit that like button and that subscribe button. This helps me a lot with the YouTube algorithm and will help my channel reach many more people who are interested in taking the personal finance journey. Also, go ahead and hit the bell icon to be notified instantly when I post a new video. I will be posting one video every week with great new financial content, and I hope to see you back here. And go ahead and follow me on Instagram, where I post every week. I'll put the handle of my Instagram account in the description below. Thank you so much for watching, and see you next time.